There are more banks than bankers. And if you think about that a bit, you'll see what I mean. There have been a lot of people that have run banks in a very injudicious manner, but that's made for opportunities for other people. A lot of banks have disappeared over time.
In the old days, the only way you could stop a run on a bank was basically for somebody to come and pile up gold. I mean, they used to race it to the branches that were having a problem. I remember reading the history of the Bank of America on that and how they would put out runs before the Federal Reserve existed. The only thing that stopped it was to pile up gold. I mean, if the CEO of the bank came out and said, our Basel II ratio is 11.4%, the line would just lengthen. It would not get the job done. Gold got the job done. Bernanke and Paulson got the job done, but the only way they got it done was saying, we're guaranteeing new commercial paper, we're guaranteeing that the money market funds won't break the bank, we're going to do whatever's necessary. I think Dodd-Frank weakens that, and I think that's a terrible thing to weaken.
I would not characterize all banks as the same. I mean, we have in this room John Forlines, who runs the Bank of Granite, North Carolina, and they've earned 2% on assets without taking any real risk. People always want a formula. They go to the intelligent investor and they think, somewhere they're going to give me a little formula and then I can plug this in and then I'll make lots of money. And it really doesn't work that way. What you're trying to do is look at all the cash a business will produce between now and Judgment Day and discount it back at a rate that's appropriate and then buy it a lot cheaper than that. And whether the money comes from a bank, whether it comes from an internet company, or whether it comes from a brick company, the money all spends the same. Now the question is, what are the economic characteristics of the internet company or the bank or the brick company that tell you how much cash they're going to generate over long periods in the future? I think that a good many banks have sold at very reasonable prices. We bought all of a bank in 1969. We bought a bank in Rockford, Illinois. There are a number of banks that over the last 5 or 6 years, on tangible net worth, a number of them have a lot of goodwill, but on tangible net worth have earned over 20% on equity. You would think that would be difficult for an industry to do, dealing in a commodity like money. And of course, the bankers will argue it's not a commodity, but it's got a lot of commodity-like characteristics. And you would think those kind of returns in a world of 6% long-term interest rates and much lower, you'd think that would be very hard. You would have thought it wouldn't have occurred. You think it'd be hard to sustain. We've been wrong in the sense that banks have earned a lot more money on tangible equity than Charlie and I would have thought possible. Now, I think to some extent they've done it because they've stretched out equity much further than was the case 20 or 30 years ago. I mean, they operate with more dollars working per dollar of equity than people thought was prudent 30 or 40 years ago. But however they've done it, a number of banks have earned very high returns on equity in recent years. And if you earn high enough returns on equity and you can keep employing more of that equity at the same rate, that's also difficult to do. The world compounds very fast. Banking as a whole has earned at rates that are well beyond, on tangible equity, well beyond, I think, much more glamorous businesses have earned in recent years. Banking is a good business if you don't do dumb things on the asset side. I mean, basically. And it's a business that the banks we own the commercial banks earn between 12% and 16% or so on net tangible assets. That's a good business. It's a fantastic business against the long-term bond, at 2%. If you have a choice between a 2% instrument and a 12% instrument, which one's going to win over time? So if you ask me whether I think banks are going to go down where they only earn 3 or 4% on tangible assets, I don't think that'll happen. They're businesses I understand, and I like the price at which they're selling relative to their future prospects. I think 10 years from now that they'll be worth more money, and I feel there's a very high probability I'm right. And I don't think they will turn out to be the best investments at all, the whole panoply of things you could do, but I'm pretty sure that they won't disappoint me. You have to know what you don't know, and you have to make sure that what you don't know isn't all important. I mean, if there's 4 boxes there, you want to get to what is knowable and which is favorable. And there's things that you'll miss out on because they belong in the other 3 boxes, one of which will be favorable, another one that's favorable. And the fact that you're missing out on 90% of the stuff doesn't really make any difference if the 10% you do is right.